Next question. Piyush Lunga and Associates presently pay a dividend of 1 rupee per share and has a share price of 20 rupees. So 1 rupee is the dividend D0 and share price is the current market price 20 is P0. If this dividend were expected to grow at a rate of 12% per annum forever, what is the firm's expected or required return on equity using a dividend discount model approach? So dividend discount model is the Gordon's model and they are expecting a growth rate of 12% per annum forever, which means you can use the constant model. We need to find the cost of equity KE. Okay, so then the details എഴുതാം. D0 is 1, P0 is 20 and as per the Gordon's growth model, V0 is equal to value is equal to D1 divided by KE minus G. So from this formula, KE minus G is equal to D1 divided by V0. KE is equal to D1 divided by V0 plus G. So KE is equal to D1 divided by P0 plus G. D1 is D0 into 1 plus G. 1 into 1 plus 12 percentage divided by P0 is 20 plus G is 12 percentage. 1 into 1 plus 0.12 whole divided by 20 plus 0.12. 17.60 is the required return on equity using a dividend discount model approach. Now let's see the second part of the question. Instead of this equation in part 1, suppose that the dividends were expected to grow at a rate of 20% per annum for 5 years and 10% per year thereafter. So for the first 5 years, it is expected to grow at a rate of 20% and from the 6th year onwards 10%. Now, what is the firm's expected or required return on equity? So now what is the key? This is a two-stage model. For the first 5 years 20% and from 6th year 10%. We need to find the cost of equity. So for that we can assume KE. So let the KE for two-stage dividend model be 20%. So first നമുക്ക് 20% assume ചെയ്യാം. 20% എന്തുകൊണ്ടാണെന്ന് വെച്ചാൽ K has to be greater than the normal growth rate as per the Gordon's model. So normal growth rate is 10%. So 10നേക്കാളും കൂടുതൽ it can go up to super growth rate. So KE 20% ആയിട്ട് assume ചെയ്തിട്ട് we can find the price. Okay, so year dividend. So for the first year, dividend is D0 plus 20%. D0 is 1 plus 20%, 1.2. Second year D1 plus 20%, 1.44. Third year D2 plus 20%. Fourth year D3 plus 20%. Fifth year D4 plus 20%. Sixth year 10% growth ആണ്. From 6th year onwards 10% growth rate. So D5 plus 10%, 2.74. Now we need to find the terminal value at the end of year 5 because the dividend is expected to grow at a constant growth rate from 6th years. So terminal value at the end of year 5 is dividend for year 6 D6 divided by KE minus G. D6 is 2.74 divided by, we have assumed KE as 20% minus growth rate for 6th year is 10%. So 27.4 is the terminal value at the end of year 5. Now we can find the present value using these details. So year 1 details, cash flow, present value at 20%, present value. So cash flow already നമ്മൾ calculate ചെയ്തു 1.2, 1.4, 1.73, 2.07. ഫിഫ്ത്ത് ഇയറിൽ വരുമ്പോൾ 2.49 പ്ലസ് ടെർമിനൽ വാല്യൂ 27.40 വരും. ഓക്കെ, പ്രസൻറ്റ് വാല്യൂ അറ്റ് ദ റേറ്റ് ഓഫ് 20% കണ്ടുപിടിക്കാം. പ്രസൻറ്റ് വാല്യൂ എന്ന് പറയുന്നത് ക്യാഷ് ഫ്ലോസ് ഇൻറ്റു പി വി അറ്റ് 20%. സോ ദ മാർക്കറ്റ് പ്രൈസ് ഇസ് 16.01 വിത്ത് 20% KE. ബട്ട് ക്വസ്റ്റ്യനിൽ സ്പെസിഫൈ ചെയ്തിരിക്കുന്ന പ്രൈസ് എത്രയാണ്? 20. സോ 20യോട് അടുത്ത് വരുന്ന KE എത്രയാണെന്ന് നമുക്ക് കാൽക്കുലേറ്റ് ചെയ്യണം. സോ നൗ ഇറ്റ് ഇസ് 16.01. സോ പ്രൈസ് കൂടണമെങ്കിൽ കോസ്റ്റ് അത്രയും കുറയണം. സോ 20% നമുക്കൊരു 18% ആക്കിയിട്ട് കാൽക്കുലേറ്റ് ചെയ്യാം. Same method. Let the KE for two-stage dividend model be 18%, year 1 to 5, details, cash flow, PE at 18%, PV. So, ഇവിടെ terminal value at the end of year 5 കണ്ടുപിടിക്കണം because KE 18% ആയിട്ട് change ആയി. So, V5 terminal value at the end of year 5 is equal to D6 divided by KE minus G. D6 we already calculated 2.74 divided by KE is 18% minus for 6th year the growth rate is 10%, so 0.10. So V5 is equal to 34.2. So ഇവിടെ 5th year cash flow is 34.2 plus D4 plus 10%. Then cash flows into PV at 18%, you will get the present value. So here we get 20.22. So market price, current market price is 20 as per the question. അതിനോട് അടുത്ത് we got the present value 20.22 at 18%. Now we can summarize cost of equity and value. So for KE 18%, the value is 20.22, and for KE 20%, the value is 16.01. Intermediately, we have studied IRR method to find the cost of equity. So as per that method, lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into change in rate ചെയ്യുമ്പോൾ you will get the cost of equity. Here, what is the lower rate? Lower rate is 18%. 18% plus NPV at lower rate is 20.22 divided by NPV at lower rate 20.22 minus NPV at higher rate 16.01 into change in rate is 18 to 22%. So under using IRR method, we get the cost of equity as 18.096. So for cost of capital of 18.096, the market price is 20. A company has a book value per share of 137.8. Its return on equity is 15% and it follows a policy of retaining 60% of its earnings. If the opportunity cost of capital is 18%, compute the price of the share today using both dividend growth model and Walters model. So we have to use dividend growth model and Walters model to compute the price of the share. We have the book value per share, then return on equity R, then retention ratio 60% and KE 18%. Okay, so തന്നിരിക്കുന്ന ഡീറ്റെയിൽസ് എഴുതാം. ബുക്ക് വാല്യൂ പെർ ഷെയർ ഇസ് 137.8, then return on equity R is 15%, then earning per share എന്ന് പറയുമ്പോൾ EPS എന്ന് പറയുമ്പോൾ book value per share into return on equity 137.8 into 15%, 20.67 is the EPS. Then retention ratio is given 60%. Retention ratio എന്ന് പറയുന്നതാണ് B. Then growth rate G is equal to B into R. Retention ratio into return on equity 0.6 into 0.15, 0.09, which is 9%. Then cost of equity question will specify that in the dividend we have to compute. Dividend is earning per share into 1 minus B. EPS we already calculated 20.67 into 1 minus 0.6, 8.268, which means 8.27. Now we can directly apply the values of to the formula of Gordon's model and Walters model. So under Gordon's model, P0 is equal to EPS into 1 minus B divided by KE minus G. We have these figures. So PO as per Gordon's model is P0 as per Gordon's model is 91.87 and Walters model P0 is equal to D plus earnings minus dividend into rate of return divided by cost of equity whole divided by KE. And ഇതിലും figures update ചെയ്യുമ്പോൾ you will get 103.34. So the market price as per Gordon's model is 91.87 and Walter model is 103.34.